It is 8 o'clock in the morning, London, Wednesday, the 16th of September, 1992. The pound is sitting on the floor of the European exchange rate mechanism, pressed against its lower limit of 2.773 Deutsche Marks. Traders across the city are selling, not cautiously, not gradually, in waves, each one larger than the last. The Bank of England opens a session buying pounds, 325 million pounds, then 300 million more. In 60 minutes, it has spent over £1 billion. The rate has not moved by a single pfennig. By 9 o'clock, it is burning through £2 billion per hour. Somewhere in New York, a man in an unremarkable office overlooking Central Park is watching all of this happen. He has already sold £10 billion worth of sterling that he does not own. He is not nervous. He has done the arithmetic. He is waiting for the government to run out of ammunition, and he knows to within a few hours exactly when that will be. 3 words will end this day, but we'll get there. His name is George Soros. He was born Georgi Schwartz in Budapest on the 12th of August, 1930, into a comfortable Jewish family. His father Tivadar was a lawyer, an Esperantist, a man who had survived Russian captivity in the First World War by escaping and walking halfway across Siberia to get home. In 1936, he changed the family surname to Soros, which in Esperanto means he who will soar. In March 1944, when Nazi Germany occupied Hungary, the boy who would become Soros was 13 years old. His father forged Christian identity papers for the family and organized false documents for dozens of other Jewish families in Budapest. He moved them between safe houses. He saved lives under conditions in which most people froze. George Soros later said that 1944 was the happiest year of his life, not despite what was happening, but because he watched his father act with total clarity inside a system that was visibly collapsing. That image never left him. In 1947, age 17, Soros arrived in London with almost nothing. He worked as a railway porter at Victoria Station. He waited tables at a nightclub in Soho. He applied to the London School of Economics and was accepted. There, he studied under a philosopher named Karl Popper, the author of The Open Society and Its Enemies, a man who had argued that no system, no ideology, no fixed belief could ever be proven permanently correct. It could only be falsified. All certainties were provisional. The world was not rational and stable. It was messy, reflexive, and perpetually incomplete. Soros turned that idea into an investment framework he called reflexivity. Markets, he argued, do not simply reflect an underlying economic reality, they actively shape it. Investor beliefs change prices. Change prices change corporate earnings and government finances. Change fundamentals shift beliefs again, not a cycle trending toward equilibrium, as standard economics assumed, but a feedback loop that amplifies, overshoots, and eventually breaks. He published this theory in a book, The Alchemy of Finance, in 1987. Most of the financial establishment regarded it as philosophy, dressed up as economics. His track record, however, was difficult to argue with. By 1992, the Quantum Fund, which Soros had co-founded in 1973 with a starting capital of $12 million, managed approximately $5 billion. Its average annual returns over 2 decades ran at roughly 30 to 35%. Through the 1970s alone, it returned 4,200% to investors against the S&P 500's 47% over the same period. Within finance, Soros was famous. Beyond it, he was almost entirely unknown. That was about to change. On the 8th of October 1990, the United Kingdom joined the European exchange rate mechanism at a central rate of £1 equal to 2.95 Deutsche Marks, with a permitted floor of 2.773 Deutsche Marks. The decision was taken by John Major, then Chancellor of the Exchequer. Margaret Thatcher had resisted membership for years. Her economic advisor had called the mechanism half-baked. Thatcher herself had a phrase she repeated to her cabinet: "You cannot buck the market." Her successors believed otherwise. A fixed exchange rate against the Deutsche Mark, they argued, would import German monetary discipline, ending the boom-bust cycles that had defined British economic life for a generation. The rate chosen was 2.95 Deutsche Marks. The rate was too high, by roughly 15 to 20%. At the moment Britain joined the exchange rate mechanism, its economy was already deteriorating. Inflation ran at nearly 11%, nearly 3 times Germany's. The housing market had begun to fall. Prices were declining at roughly 10% per year. Unemployment was rising toward 9.9%. More than 3 million people out of work. But the feature that made the situation truly dangerous had been identified by Soros's London office head, Scott Bessent, who would later serve as the 79th United States Secretary of the Treasury. Bessent had analyzed the British mortgage market and found a structural vulnerability with no equivalent in Germany or France. Around 90% of British mortgages were tied to variable interest rates, not fixed, variable, overnight, which meant that every single rate rise used to defend the pound landed directly on millions of homeowners. The same week it was announced, there was no buffer, no delay. The link between monetary policy and kitchen table pain was immediate. Bessent had already taken a short position in British homebuilder stocks. He was watching the structural fault line. It was only a matter of finding the earthquake. Then Germany reunified. On the 3rd of October, 1990, just days before Britain joined the mechanism, the two Germanys became one. Chancellor Kohl converted East German marks to West German marks at an exchange rate of roughly 1.8 to 1, far more generous than the economic fundamentals justified. Overnight, the German money supply jumped roughly 15%. Over the following 3 years, the federal government spent more than 350 billion Deutsche Marks on the eastern states, building infrastructure, paying salaries, absorbing unemployment. The inflationary pressure this created inside Germany was real. The Bundesbank, being constitutionally required to prioritize price stability above all else, began raising rates aggressively. By July 1992, the headline rate stood at 8.75%, a post-war record. This created an irreconcilable conflict at the heart of the exchange rate mechanism. Germany needed high rates to cool its reunification boom. Britain, Italy, Spain, all of them needed low rates to escape recession. But the mechanism forced everyone to orbit the Deutsche Mark. Britain could not cut rates without triggering a collapse in sterling toward the floor, and it could not raise rates without destroying the housing market. On the 2nd of June, 1992, Denmark voted against the Maastricht Treaty and by a margin of 50.7%. If Denmark wouldn't sign, the entire project of European Monetary Union was in question. France was scheduled to vote on the same treaty on the 20th of September, 4 days after Black Wednesday, and opinion polls showed the margin within the margin of error. The architecture was weakening. All it needed was a crack. Before we follow the money, it is worth pausing on what the exchange rate mechanism actually meant for ordinary people in Britain in the summer of 1992. Unemployment had been rising for 2 years. By that September, the official figure stood at 2.76 million, nearly 10% of the workforce, the highest rate since 1986. Young people were moving back in with parents. Businesses were closing. In the repossession courts of England and Wales, more than 75,000 homes had been seized by lenders in 1991 alone. In the postal districts of Birmingham, Bristol, and Manchester, entire streets sat in negative equity. Owners unable to sell, unable to move, unable to leave. The Treasury knew the numbers. What it could not admit was that the solution, leaving the mechanism, allowing sterling to find its own level, would require acknowledging that the rate of 2.95 Deutsche Marks had been wrong from the start. That was not a technical concession. It was a political catastrophe. John Major had staked his entire economic credibility on membership. To leave would be to admit that the government had spent 2 years inflicting unemployment and repossession on its own voters in defense of an unsustainable position. And so they stayed, and the pressure mounted. And across the Atlantic, the calculations were nearly complete. By the summer of 1992, Quantum Fund had built a short position against sterling worth $1.5 billion. The logic was straightforward. The pound was overvalued. The government could not raise rates without wrecking the economy. And the mechanism's own rules gave speculators a one-way bet. If the peg held, losses were minimal. If it broke, the gain could be 15 to 20% on a multi-billion-dollar position. The man executing this trade was Stanley Druckenmiller, Quantum Fund's portfolio manager since 1988. Born in 1953 in Pittsburgh, a college economics major who had left his doctoral program at the University of Michigan to take a job at a bank instead, Druckenmiller had founded Duquesne Capital Management in 1981. Over nearly 30 years of active management, he had never, not once, finished a calendar year with a loss. His approach combined meticulous macro analysis with something unusual: the willingness to act at scale in moments of maximum conviction. On the 5th of September, at a summit of European Union finance ministers in Bath, Chancellor Norman Lamont had effectively demanded that Bundesbank President Helmut Schlesinger cut German rates. Schlesinger had been furious. He gave no reassurance. 8 days later, Italy devalued the lira by 7%, the first major exchange rate mechanism adjustment in 5 years. The cracks were widening. Then, on the evening of the 15th of September, Schlesinger gave an interview to the Wall Street Journal and the German Handelsblatt. The agreement was that direct quotations required his prior approval. Paraphrases did not. A wire service summary moved that night across Reuters terminals from Frankfurt to London to New York. The Bundesbank president had not ruled out that one or two currencies might come under pressure before the French referendum, even after any realignment of exchange rates. He had not named sterling. He didn't need to. Druckenmiller came to Soros with a plan: gradually increase the position, perhaps doubling it to $3 billion. Soros's response was not enthusiasm. It was closer to contempt at the smallness of the number. Druckenmiller recalled, "Soros taught me that when you have tremendous conviction on a trade, you have to go for the jugular. It takes courage to be a pig." The reasoning was precise and unsentimental. Sterling was liquid. They could exit a losing position within hours. Maximum downside, approximately 0.5%. If the peg broke, the upside, 15 to 20%. Probability of the peg breaking within 3 months, around 90%. Soros's formulation, as later described: "This doesn't make sense. If the news is true and the downside is almost zero, why not go for $15 billion? Over the course of that night, the position tripled from $1.5 billion to approximately $10 billion, achieved through leverage running at 200% of the fund's total assets. Other major hedge funds were on the same side of the trade, but none with a position approaching quantums in scale. It was now past midnight. The London market would open in less than 8 hours. Before 8 in the morning, Asian markets and early European sessions are already selling sterling. By the time London opens, the pound is sitting at approximately 2.78 Deutsche Marks, pressed against the floor. 8 o'clock, the Bank of England enters the market, 325 million pounds, then 300 million more. The rate barely moves. Reserve consumption, over £1 billion in the first hour. Burn rate, £2 billion per hour, 9 o'clock. Norman Lamont calls John Major. The purchases are not working. Major asks Lamont to keep buying. 10:30 in the morning. The first rate rise from 10% to 12%. A 200 basis point move announced outside the bank's normal schedule. Markets read the hesitation as weakness before they read the number as resolve. After a brief pause, selling resumed with greater intensity. In New York, Druckenmiller and Soros were watching from across the Atlantic. They saw the rate rise not as a show of strength, but as the act of a dying patient reaching for a last available drug. It was a signal that the end was close and a reason to press harder. 2:15 in the afternoon, a second rise is announced to 15%. Effective the following morning, the gilt market barely moves. The foreign exchange market does not move at all. Traders do not believe it will ever take effect. They are right. 4 o'clock, London market close. Marchantilier worked the sterling and Deutsche Mark desk at one of the largest trading operations in the city. Every day at 4 o'clock, the Bank of England would announce over a trading floor speaker that it was passing its sterling bid to the Federal Reserve in New York, then to the Reserve Bank of Australia, then to the Bank of Japan. Always the same words, always the same order. It was ritual. It was continuity. On this day, the speaker produced 3 words: I don't pay. The silence that followed seemed to last forever, though it was probably a second. The market had beaten the Bank of England. Then the floor fell out of the market. 7:40 in the evening. Norman Lamont stepped out onto the stone steps of Her Majesty's Treasury. Behind him, half in shadow, stands a 25-year-old special advisor named David Cameron. Lamont reads from a prepared statement. Today has been an extremely difficult and turbulent day. Massive speculative flows continue to disrupt the functioning of the exchange rate mechanism. The government has concluded that Britain's best interests are served by suspending our membership. The 15% rate never takes effect. The next morning, it returns to 10%. Sterling enters a free float. In a single day, the Bank of England had spent approximately $22 billion from its foreign exchange reserves, roughly 40% of the total. Net loss to British taxpayers, confirmed by the Treasury in a Freedom of Information request in 2005. £3.3 billion. Soros's profit, approximately $1 billion. Before the end of the year, the Quantum Fund would close 1992 with a total return of 69%. Soros, speaking later, offered a single sentence on the subject of the defense. When Norman Lamont said he would borrow nearly $15 billion to defend sterling, we were amused, because that was roughly the amount we wanted to sell. The political damage was immediate, and as it turned out, permanent. Before Black Wednesday, the Conservatives held 43% support in opinion polls. Within 1 month, that had fallen to 29%, a drop of 14 points in 30 days. The Labour Party moved into a lead it would not relinquish for 4.5 years. Opposition leader John Smith delivered one of the most economical insults in parliamentary history. A devalued prime minister of a devalued government. John Major that night sat alone and considered resignation. He later wrote that he was privately unsure whether he could or should remain prime minister. He was persuaded to stay. Norman Lamont was dismissed the following May. In his resignation speech to the House of Commons on the 9th of June, 1993, he delivered a line that entered the language. The government, he said, gave the impression of being in office, but not in power. At the 1997 general election, the Conservative Party lost 179 seats. Labour won a majority of 179. its largest since 1935. But the economic consequences moved in a different direction entirely. Freed from the exchange rate mechanism, the Bank of England cut rates from 10% to roughly 5.5% to 6% by 1993. In October 1992, just weeks after the exit, Britain adopted inflation targeting as its monetary policy framework, setting an explicit numerical target for inflation rather than defending an exchange rate. That policy became one of the most influential monetary innovations of the late 20th century, copied by central banks across the world. Inflation, which had run at 10.9% in 1990, fell to 1.3% by 1993. GDP grew approximately 2.3% in 1993 and 4% in 1994. The FTSE 100, which stood at 2,370 on the eve of Black Wednesday, had tripled to 6,930 by December 1999. Some conservatives, including Norman Tebbit, who had called the mechanism the eternal recession mechanism, began to refer to the 16th of September as White Wednesday. Lamont himself, looking back years later, conceded, "It was a political catastrophe, a great humiliation, but it set the next 15 years of growth." The 3 million people who had been unemployed, the hundreds of thousands whose homes had been repossessed, the families sitting in negative equity in 1992. They had absorbed the cost of a policy that could not be defended. When it finally ended, the recovery that followed was real and sustained. The policy was wrong. The exit was humiliating. The outcome economically was better than anyone had predicted. That is not vindication. It is history. Soros did not break the Bank of England. The bank was already broken by a rate that was too high, set by a government that could not admit the error without losing political face. What Soros did was apply the logic of reflexivity. The harder the government fought the fixed rate, the more obvious it became that the fight was unwinnable. Each defensive move attracted more sellers. The peg was not defeated by speculation. Speculation made the defeat visible, faster. Druckenmiller found the trade. Soros turned it into something larger by insisting on size, on the principle that conviction without proportional position is worthless. His rule, which Druckenmiller would carry for the rest of his career: it is not enough to be right about the direction. You must be willing at the moment of maximum pressure to hold that scale. The long-term consequences stretched further than anyone in that September had anticipated. Black Wednesday made British membership of the Euro politically impossible, not formally, but practically. The wound was too visible, the humiliation too fresh, the memory too durable. In 1993, the United Kingdom Independence Party was founded. The intellectual and political thread running from the 16th of September 1992 to the referendum of the 23rd of June 2016 is not invisible. It is simply long. Several historians have called Black Wednesday the first Brexit. The second was initiated by David Cameron, the 25-year-old who stood half in shadow behind Norman Lamont on those Treasury steps, and the man who arrived in London in 1947 as a penniless refugee, who waited tables in Soho, who studied philosophy under Karl Popper and turned it into the most effective speculative framework of the 20th century. He went on to donate more than $32 billion to democratic causes and civil society organizations around the world. He was vilified in some countries and celebrated in others. He remained a contradiction. A man who had made $1 billion from one of the worst days in modern British economic history, and who had spent decades trying to build the kind of open, accountable society his father had protected under occupation. Margaret Thatcher said it plainly: you cannot buck the market. Her successors tried at enormous cost to the public finances, to the housing market, to the 3 million who spent the recession years without work. The market answered. It is 4 o'clock in the afternoon, London, the 16th of September, 1992. The speaker crackles. 3 words. I don't pay. The Bank of England spends £3.3 billion of public money in a single day and fails to move a currency by a single pfennig. A refugee who arrived in this city in 1947 with no money, who worked as a porter and a waiter before putting himself through university, makes approximately $1 billion in the same afternoon. The British economy, while freed from the constraint it had defended at such cost, grows faster over the following decade than at almost any point in its modern history. Markets are not efficient mechanisms that tend toward equilibrium. They are reflexive systems that amplify conviction until something breaks. The lesson of Black Wednesday is not that governments are weak or that speculators are strong. It is that a fixed price, held in place by political will against economic gravity, does not hold indefinitely. It holds until it doesn't. This has been Legends of Markets. If you found this episode worth your time, subscribing takes 10 seconds, and it means we can keep making them.